the reasons are off, maybe the timing is off, but given where valuations are, could this be a signal that they're not going to get a lot richer?
It's very interesting because the valuations today for the banks are quite inexpensive when you look at it from a price to book or price to tangible book basis. We have to remember that due to the accounting regulations, the banks are taking out of their book values the unrealized bond losses in their available for sale portfolio. And those portfolios, of course, are government guaranteed securities or government securities. So there's no credit risk. It's a duration issue. So those book values, the book values will certainly grow as those unrealized losses come back into book value.
Okay.
But what's also interesting is that, they are concerned, Fitch, about rising rates, and should the Fed be at its terminal rate for Fed funds, which may be the case in September, then it's quite positive for the banks because banks do quite well after the Fed finishes reaching the terminal rate.
It's taken a while for banks to start passing along to depositors the benefits of those rates. How much of a discrepancy is there between how well off the largest banks are and some of the regional banks? I know there's a huge spread on the different sizes of the regionals, but even some of the larger regional banks here that perhaps are going to be looked to be active in consolidating the regional banks. What's the risk there?
It's going to be interesting because for all of the banks, whether it's a regional or a money center bank, when the Fed in the last 4 tightening cycles, when they've reached the terminal rate for Fed funds, meaning it doesn't go up any higher, within 6 months, the deposit rates or deposit beta for these banks stops going higher. However, the cash flows coming off of the securities portfolios and loan portfolios continue to be reinvested at higher yields than the current portfolio that they're coming out of. And as a result, the margins stabilize and improve. Right. So therefore, I think you're going to find regionals and the money centers benefit. Plus, should the forward yield curve be accurate and we start seeing Fed fund rate cuts next year, the custody banks are the ones that are the biggest beneficiaries because they've passed on the most of the rate increases to their customers already. So they'll be the quickest to cut when the Fed starts cutting. Right.
You say when the Fed starts cutting. We were just talking about that with Steve Leisman and Julia Coronado. It might not come as soon as some hoped. And when you factor that in, along with the commercial real estate issues that we see both with office and increasingly with multifamily residential, isn't that a danger on the books of some of these regional banks that makes this different from what we've seen in previous cycles?
Well, it depends. It really is going to, again, higher for longer, as your prior folks were talking about, commentaries were mentioning. That's quite positive for the banks. Once we get to the terminal rate, and let's assume for a moment Fed funds stays at 5.5%, 6% through all of 24. That is very positive for the banks because, again, the cost of funding stops going up, but the yields continue to rise on the asset side.
Well,
so
for
they
the
get
banks,
more revenue.
But what about for the borrowers who have, these loans out on commercial real estate that are going to need to roll them over? If it's bad for those borrowers, it's not good for the banks for long, right?
Yeah. So now, great point. So now let's go to the commercial real estate borrower. So if the borrower has a 3.5% fixed rate mortgage on the property that was taken out 5 years ago, the property's cash flowing fine, but now they have to refinance in a 7% market, and it's harder, or not 7, but let's call it 5. It's more difficult. But the banks work with those customers. The banks don't foreclose on properties like that. They work with the customers. The customers have to come up with maybe more cash for equity as a down payment, or they have to build out different tranches of debt, but they can work with them. But to your point, on commercial real estate, where there's big defaults because the buildings are half empty, they're not cash flowing, that's a real problem. But so far, most of those problems are not in the commercial banking industry, but the shadow banking industry with the commercial mortgage-backed securities. Mm-hmm. That's where the problems are happening right now.
But is that something to watch here, then? Is that supply of real estate, commercial real estate on the market? If people start to throw their hands in and say, okay, more and more we're willing to take the hit here and do this sale for less than we paid, and supply comes onto the market, then all of a sudden, right, a lot of people, including some banks, have a problem, right?
I would say, no, that's fair. I mean, what you're going to see are more, as those properties are foreclosed upon, they're going to be sold at fire sale prices already. Alternative investors, alternative asset managers are building up their war chest to buy these properties at, let's say, 30, 40, 50 cents on the dollar. They'll refurbish them and there'll be new competition. Yes, that will certainly be an impact, but that doesn't happen over 3 or 6 months. That's a multi-year, kind of change. But will it weigh on property values? Yes. Will it weigh on some of the banks? Yes.